Our next scenario is called the DIY deduction disaster. Imagine someone, let's call him Bob, trying to minimize his tax burden. He's heard about all these deductions and decides to claim as many as possible, stretching the truth a little here, overlooking a requirement there. Bob thinks he's being clever, but ends up facing an accuracy related penalty due to negligence. So, Sam, let's start with some common misconceptions. What are some of the things people get wrong about tax deductions that can land them in hot water? And Taylor, what are your initial thoughts on this? What kind of mistakes do you think people might make?
Well, I think sometimes people hear about a deduction and assume it applies to them without really digging into the specifics. Like maybe they heard a friend talking about deducting home office expenses and just assume they can do it too, even if they only occasionally work from home. Or maybe they're not keeping good records. I know I struggle with that sometimes.
Taylor, you've hit on two major points: eligibility and documentation. A common misconception is that any expense remotely related to work is deductible. The reality is each deduction has specific criteria. The home office deduction, as you mentioned, has strict rules about exclusive and regular use. Another misconception is that estimations are good enough. The IRS wants to see documentation, receipts, invoices, logs, proving the expense was incurred and qualifies.
That's a great point about documentation, Sam. It's like trying to return a shirt without the receipt. The store needs proof of purchase. The IRS operates similarly. Taylor, does that analogy make sense?
Yes, totally. So if I understand correctly, even if I'm technically eligible for a deduction, I can still be penalized if I don't have the proper documentation.
Exactly. The IRS Publication 17 calls this negligence, failing to keep adequate books and records. And remember, even a seemingly small oversight can trigger a penalty equal to 20% of the underpayment.
Let's talk about ways to avoid these issues. Sam, what advice would you give someone like Bob in our scenario to ensure they're claiming deductions accurately?
First, understand the rules. The IRS publications and website are valuable resources, though they can be dense. Consulting a tax professional can provide personalized guidance. Second, maintain meticulous records. Organize your receipts, track mileage, keep a log of business expenses. Software can automate this process. Third, if you're unsure about a deduction, err on the side of caution. It's better to miss out on a small deduction than to face a significant penalty.
This reminds me of what we discussed about reasonable cause in the last segment. Even with good intentions, ignorance of the rules isn't a defense. So if I'm unsure, I should really seek clarification either through reliable resources or by talking to a professional.
Absolutely, Taylor. That proactive approach can save you a lot of trouble down the line. So, to recap, accuracy-related penalties can stem from negligence, including claiming ineligible deductions or lacking proper documentation. Maintaining accurate records and understanding the specifics of each deduction is crucial. And if you're in doubt, consult a tax professional or utilize reputable resources like the IRS website or publications. Don't be a Bob. Take the time to understand the rules and keep accurate records. Speaking of specific rules and potential pitfalls, let's move on to another scenario where accurate reporting is paramount, a situation involving undisclosed foreign accounts. This can have even more serious consequences, as we'll explore next.